Hello everyone, good morning and welcome to today's Audit and Assurance Revision Class 2. So yesterday we stopped at a concept of audit risks and auditors' responses. Today we're going to complete that, and after completing that we're going to solve a question on the same. Okay, so let's do it. I will just share my screen with you. Okay. Yesterday we stopped here at performance materiality. I would like to repeat this concept once again. Performance materiality is the amount set by the auditor which is below materiality. For what? Because say for example in a particular scenario, materiality is 500. So one misstatement is 400, one misstatement is 300, one misstatement is 200. Individually they are not material, but when you aggregate them together they become material. So to solve this issue and to address this issue, concept of performance materiality came by the auditor, because the auditor somewhere realized that see, if I set the materiality at 0.5 to 1% of a profit, so 0.5 to 1% of profit, say for example it is more than 500 to 1000, okay, but individual amount less than 500 are not material. But if there are 400, 400, 400, 400 immaterial misstatements, but when you aggregate them together they become material. Yes, because 4, 4, 4, 4 becomes 16, right? So that is why this issue is now material, because above 500 anything is material, right? So to address this issue, the auditor came up with the concept of performance materiality. This is the amount set by the auditor at less than materiality for financial statements as a whole, to reduce an appropriately low level the probability that the aggregate of uncorrected or undetected misstatements exceeds materiality for the financial statements as a whole. The auditor sets performance materiality at a value lower than overall materiality and uses this lower threshold when designing and performing the audit procedures. So what is performance materiality? It is a level set below materiality. So if the materiality is 500, say performance materiality is 300, or say performance materiality is 200. This reduces the risk that the auditor will fail to identify misstatements that are material when added together. Okay, so this is the concept of performance materiality. Next we have is risk assessment procedures. That means if you want to find out more about a risk that the business is facing, okay, if you want to address the risk, if you want to solve this risk, what are the risk assessment procedures that the auditor should perform? Risk assessment procedures are procedures to solve the risk. Okay, risk assessment procedures. So the auditor should perform the following risk assessment procedures to solve the problem of risk. The first one we have is inquiries with management of appropriate individuals within the internal audit function, if there is one, and others with relevant information within the client entity about external and internal changes the company has experienced. So first of all, whenever there's a risk in the company, the first thing that the auditor has to do is inquire with the management of appropriate individuals within the internal audit function regarding what exactly the risk is and what is the depth of the risk. So the first step about risk is inquiry. Second is you will perform analytical procedures. Now what are analytical procedures? analyzing relationship between information and checking for any errors. Analytical procedures means comparing the data, comparing information. Now for comparison, you need two datas. One data is our current year. You can compare current year with last year, or you can compare current year with similar competitors. So these are analytical procedures, analyzing relationship between information and looking for any, add or less, means any changes. The third thing that you will do is observation, and observation is the best thing you can do. Just observe how the procedures are being controlled. What are the control procedures in the company? If the control procedures in the company are working properly or they're not working properly, how strong the company is in terms of controls. Then next we have is inspection. Once you observe and inquire and compare, you can then inspect the key documents. You can inspect the key strategic documents and procedural manuals. So you can go yourself or with your team and inspect things out. These are the risk assessment procedures that the auditor should conduct or the auditor should follow. Inquiries, analytical procedures, observation and inspection. Very important 4 points. If you want, you can write it down just now. If you want, you can write it down just now. 4 risk assessment procedures to reduce the risk to an acceptable level or eliminate it completely. Next we have is a detail about analytical procedures. As I told you guys, what are analytical procedures? Analyzing the relationship between information and looking for any fluctuations. You can write it down in your own words. But this is the typical definition of analytical procedures. Evaluations of financial information through analysis of plausible relationships among both financial and non-financial data and investigation of fluctuations. In the year 1, your sale was 100. In the year 2, your sale became 200. Why is there a fluctuation in that? Yes, find it out. Fluctuation you will understand only when you compare two datas. Okay. You can compare financial data or you can compare non-financial data. And then you can investigate the fluctuations. So if the fluctuation is of 150 or if the fluctuation is of 200, why this fluctuation has occurred? Okay, so you can investigate the fluctuations. Inconsistent relationships or amounts that differ from expected values by a significant amount. So when you find out why the fluctuation has happened, you will 100% get an idea of, okay, this fluctuation has happened because of this relationship problem or because of, this reason. So, but you have to investigate that reason. So first, in analytical procedures, you will compare the data of current year with the previous year or data like that, and then you will find out the reasons for the fluctuations in the same. So that is analytical procedures. Now, what are the analytical procedures that the auditor will follow? Okay, while the auditor is comparing data, say current year data with last year data, or say current year data with the data of a competitor of a similar category. Yes, what are the analytical procedures that the auditor will follow? First one, the auditor will help identify inconsistencies, unusual transactions or events, and amounts, ratios, and trends that might have audit implications. In this particular year, if there is any inconsistency means every year something has been happening, but this year that thing has not happened. It's not consistent this year. Every year there's a sale of 10,000, 10,000, 10,000, but this year it is something different. So that is an inconsistency. So if there is any inconsistency, catch that, identify that. If there is any unusual transaction or event, see that, for example, every year the sale used to be within the range of 10,000. This year it is 1 lakh. It's very unusual. Like every year 10,000, 10,000, 10,000. This year 1 lakh. How? Is it a fake amount of sale? Find it out. Inconsistencies, unusual transactions or events, and amounts, ratios, and trends that might have audit implications. Every year the business kind of, even if the business is growing, the growth will be organic. ऐसा नहीं है कि 1 year it will be 10,000, next year it will be 1 lakh. The growth has to be organic. So if there is any unusual fluctuation that you kind of notice, you have to write it down and you have to find out the reasons for the same. Then next analytical procedure that the auditor follows is help identify risk of material misstatement due to fraud. A lot of times in the companies, fraud takes place. And because of fraud, there might be misstatements, because fraud is an intentional act. There is fraud and there is error. Both causes misstatement, but error is unintentional and fraud is purposeful, intentional. So if you uncover or discover any fraud in the company, obviously with every fraud will come a misstatement, and that misstatement can be material. So help identify risk of material misstatement due to fraud. Identify and assess aspects of the entity of which the auditor was unaware. So auditor comes into the company once in a year and he audits the company and goes away. The entire year what happens in the company, we are not aware of the same. There might be many problems that the entity might face. There might be many issues that the entity might face which auditor might not be aware of. So if any such problems are there, auditor needs to be aware of the same. Okay, this is the issue that is happening, or this is the problem that is happening with with the company. Comparable information for prior periods. For example, this year I'm auditing only 6 months. Okay, this year I'm auditing only 6 months because the company is closing down. So while I compare the data, I cannot compare current year's 6 months with last year's 1 year. I need to have equal data for comparison, right? I cannot compare the result of a 3-year-old and a 13-year-old. If I really want to compare, they both should have the same benchmark. They both should have something in common. There should be a common base, like a common class or a common standard based on which I can, compare. So I cannot compare a data from this year 6 months and last year 12 months. I need to have a common base of comparison. So if I'm comparing this year's 6 months, I need to convert last year's data to 6 months. Last year's 12 months data, I have to first change and transform it to the 6 months data. And then 6 months common base, and then I can compare. So similarly, you need to have comparable information of prior periods. It should not happen that one I'm comparing for 8 months and others 12 months. The both should have the common base. Anticipated results of the entity, such as budgets or forecast, or expectations of the auditor, such as estimation of depreciation. So again, any budgets that the company is making, any forecast, the auditor has to look through it. Expectations of the auditor. Every auditor has some kind of expectations when he enters into the company to audit the company. So what are those expectations? Such as estimation of depreciation. Yes? Then similar industry information such as comparison of the entity's ratio of sales to accounts receivable with industry averages or with other entities of comparable size in the same industry. Now, every year you cannot just compare your company current year data with prior year. You somewhere or the other feel the need to understand that where do I stand in the competition in the industry of similar companies. For example, if I am making chocolates, okay, and every year I'm organically growing, okay, my chocolate brand is pretty strong. Every year there's an organic growth that I'm facing. I'm very happy also. The sales are proper, they're increasing. People are loving my chocolates. I'm comparing my current year data with prior year. But at some point of the time, I will need to understand where I stand in industry competition. Because there are so many chocolate brands. There's Cadbury, there's, something else, there's something else. But where do I stand in that? Where is my position in the industry? So what I will do? I will compare my data with the industry average. and then I will understand that what is my ranking in the industry where I am. Because if I only compare within myself, I will not be able to grow. Until and unless I compare with the entire industry of the chocolates, I will not able to grow. My growth will be stagnant. So once I compare with the industry, I will understand, okay, my ranking is, say for example, 30th. I want to somewhere reach in top 10. So then I will work hard. What else can I do? I'll introduce new flavors. I will introduce chocolates sugar free. I will introduce dark chocolates. I will introduce milk chocolates. I will introduce special chocolates for kids. I will introduce special chocolates for teenagers, for old people, with less sugar, with this, with that. All these ideas, innovations I will give. I will give as pure as possible. I will not use preservatives or whatever. I'll advertise myself such. Because if you see the public today, the public has become very conscious regarding their health. Okay, 10 years back, I remember when I was in a certain age, I didn't see my elders being so conscious about what they were eating. But today, I don't know about others, but at least I am very conscious about what I eat, about the amount of sugar that I intake. So I have this limitation of I will only intake this much sugar per week. And I feel likewise, many people have become very conscious about what they eat. 10 years back from now, I would see people hogging desserts at weddings and, eating so much, and they used to, like enjoy, but they didn't know the side effects of the same. But today, people have, there's so much out there on the internet. 10 years back, internet was not that famous, wherein you just go and Google things and you find it out. Today, we're reading so much on the mobile that we know that, yeah, sugar is something which we should be, thoughtful of while consuming. And that is why, I started this like around 7 years back. I thought that no, because previously even I used to like enjoy my dessert and enjoy my food. And then somewhere I thought that no, this is not the lifestyle that I want. I will want to limit the intake. So, at the beginning, when you do that, you feel giddy, you feel nauseous, you feel angry, you feel sad, because that sugar gives you that happiness from within. Like if you consume a piece of dairy milk, it will give you that happiness. But slowly your body starts adapting to that. Okay, your body starts adapting to that situation, and then you start, you start feeling healthy, that yes, okay. And now the intake has been so less that even if I have like a small piece of something which is very sweet, I find it too sweet for my taste, because I'm not used to having, that much bomb of sugar. Everything that I eat is, like a dark chocolate, or even if it's a normal chocolate, I'll eat only little, or in my tea also I'll put just little bit of sugar. I'll put a sugar free, so that taste is, within over the years, it's been reduced. So then when I taste the normal sweet or anything like that, I feel it's too sweet. Or whenever I eat an ice cream, I feel it's too sweet for me. Okay, so then I avoid eating that, because my body cannot take that. So similarly, when I am doing that business, if I want to be number one into the industry, I will make sure that I have chocolate for every category, because see, I want to grow. At number one, there's Cadbury. Okay, I am a small scale chocolate dealer. What can I do to grow and make a place in today's market? Today people have become conscious, is the moral of the story, which 10 years back people were not. I will introduce different chocolates for different age groups. For example, above 50 people who have diabetes but love chocolates, I will make sugar free chocolates for them. Other category, I will make jaggery chocolates for them, which is exactly the same taste like the sugar. For teenagers who like want to, maintain their selves and not have a lot of sugar, I will make less sweeter chocolates for them. Yeah, or I will make dark chocolates for them, or I will make something else for them. Kids who love chocolates, who love candies, I will make a healthy version of chocolate for them. So like that. With that, what will happen? I will get all types of audience. Yes, because I'll market it that way. Yes, and then somewhere I can grow. But if I don't compare with the industry, I will be like a horse who's just seeing, just what is in front of him. So I will feel, okay, last year my sale was 50,000. This year I made 1 lakh, I'm growing. Last year my sale was 1 lakh. This year I made 5 lakh, I'm growing. But unless and until I see the entire picture of the industry, I will not be able to understand where I'm standing. So that is very important for me. Okay, so similar industry information is very important to sort of compare yourself with the industry. Then very, very important, key ratios. Key ratios are in every paper. You take AA, you take FM, you take FR, you take SBR, any paper, every paper has ratios, and every paper at least there is like little part of the question wherein you're asked to calculate ratios. So very important. The first is the profitability ratios. From that, the gross profit margin, gross profit upon sales, revenue into 100. Yesterday we were seeing one paper on the test reach, and there was a question of finding ratios, if you remember. So it comes as a part of question in every paper. Okay. Yesterday's paper it was 4 marks. Okay. So profitability ratio, gross margin, gross profit upon sales into 100, operating margin, operating profit upon sales into 100, then efficiency ratio, receivables collection period, receivables upon revenue into 365, because receivable collection period, and period is in days, so into 365. If you want in months, you do into 12. Okay. Payables payment period, again period into 365, so payables upon purchases. Inventory holding period, inventory upon cost of sales into 365, again because it's period. Asset turnover, revenue upon total assets. What is assets turnover? How much assets you're buying with the revenue that you're making. Okay, so revenue upon total assets. Then liquidity ratio, current ratio, current assets upon current liabilities. Quick ratio, current assets minus stock, that is minus inventory, upon current liabilities. So current ratio and quick ratio, there's just one difference. In quick ratio, you're subtracting inventory from current assets. Then next we have is investor ratios. Gearing is the amount of risk that a business faces. So what is the gearing ratio? Gearing ratio is borrowings divided by share capital plus reserves. Then return on capital employed, ROCE, profit before interest and tax, upon share capital plus reserves plus borrowings. Okay, so these are the key ratios. Very, very important in any exam that you give. Now you're giving AA. In the future, you will give FM, FR, whatever papers you give, this is equally important and you need to know about the same. Okay. So after this, we're going to begin solving questions on audit risks and auditors' responses. Okay, so I'll take a break of 5 minutes and then we begin solving the questions. Okay, so I will share the ACCA study hub with you guys. Okay, this is a study hub that I showed you yesterday. Let's practice on the study hub so it'll be clear of how to do things on that. So I will select a question which has audit risks and auditors responses, so you will understand it better. Okay, so let's start with selecting a question. Okay, let's do this one, Sycamore Science. Okay, and this will also give us an automation of automatic time will also be calculated, so it will be easier. So this is the question. Then the purpose of review engagement and how it differs from external audits, and describe the level of assurance provided. Okay, so this is a complete 20 marker question. Let's start by solving this particular question. Okay. So as I told you and as I have always explained, you should start by reading the requirement. So let's start by reading the requirement. Requirement A, state Maple and Company's responsibilities in relation to the prevention and detection of fraud and error. So what can Maple and Company do in relation to prevent and detect the fraud and error that happens in the company? Okay. Describe 6 audit risk and explain auditor's response to each risk. Just now we did audit risk. Now we are going to describe 6 audit risk and explain auditor's response to each risk. The next we have is Sycamore Company's new finance director has read about review engagements and is interested in the possibility of Maple and Company undertaking these in the future. However, she is unsure how these engagements differ from an external audit and how much assurance would be gained from this type of engagement. Explain the purpose of review engagements and how this differ from external audits, and describe the level of assurance provided by the external audits and review engagements. Now let's read the question. It is 1 July 20x5. You are the audit supervisor of Maple and Company and are currently planning the audit of an existing client, Sycamore Company, for the year ended 31 May 20x5. Sycamore Company is a pharmaceutical company which manufactures and supplies a wide range of medical supplies. The draft financial statement show revenue of $35.6 million and profit before tax of $5.9 million. Sycamore Company's previous finance director left the company in January 20x5 after it was discovered that he had been claiming fraudulent expenses from the company for a significant period. Now see here, he left the company after it was discovered that he had conducted a fraud. After that, he left in Jan 20x5 and a new finance director was appointed in Feb. She was previously a financial controller of the bank. Now this is a pharmaceutical company and she was previously a controller of the bank. So will she have the necessary skills and experience required for a pharmaceutical company? Yes, and has expressed surprise that Maple and Company had not uncovered the fraud during last year's audit. During the year, Sycamore Company has spent $1.8 million on developing several new products. These projects are at different stages of development, and the draft financial statements show the full amount of 1.8 within intangible. Now the full amount of 1.8, how they have put in intangible? because all the projects have not even reached the development stage. And the standard says that when all the products reach the development stage only, you can put the entire amount in intangible asset. So this is wrong. They should have partly done it according to how many projects have reached the completion stage. And the remaining amount should have been expensed out, but they have capitalized the entire amount, which is wrong, because it may be possible that several products have not even reached the development stage, and maybe in the future they might not reach also. So that amount capitalization is wrong. Those who will not reach that stage, they need to be expensed out. In order to fund this development, $2.0 million was borrowed from the bank and is due for repayment over a 10-year period. The bank has attached minimum profit targets as a part of the loan covenants. The new finance director has informed the audit partner that since the year end, there has been an increase in the number of sales returns, and that in the month of June, over $0.5 million of goods sold in May were returned. Maple and Company attended the year-end inventory count at Sycamore Company's warehouse. The auditor present raised concern that during the count there were movements of goods in and out of the warehouse, and this process did not seem well controlled. During the year, a review of plant and equipment in the factory was undertaken, and surplus plant was sold, resulting in profit on disposal of 210,000. Now this is a huge amount of profit. Okay, so if profit on sale is too much or too little, that gives an indication that the depreciation policy of that particular plant and machinery was not proper. Okay, so now let's start solving this question. We have taken 6 minutes to read the question. Now plan the answer. Now the only problem here is that for audit risks and audit responses you require a table. But here, I don't know, in the real exam they give you a table, but here the table is not given. So what we will do is, we will write the risk and below that we can write the response. Okay. So only this many options are there. So what is the first part? State Maple and Company's responsibilities in relation to prevention and detection of fraud and error. Now in the real exam, you have separate slides. I showed you yesterday. So their part A is already written. You just have to type the answer below that. But here it is not written. I will just type it. In the real exam, it's not required. Okay. So this is the A part. So let's do the A part. State Maple and Company's responsibilities in relation to prevention and detection of fraud. Now, Maple and Company is the auditor. Okay, now what are auditors' responsibilities for fraud and error? It's actually the responsibility of the management to prevent and detect fraud. But what is auditor's responsibility in case of fraud? So let's see. Let's write down. Fraud responsibility. What is auditor's responsibility in case of fraud? Auditor is not responsible for fraud in any way, but auditor is responsible for providing a reasonable assurance that the financial statements taken as a whole are free from material misstatement which are caused by fraud and error. The auditor is not having responsibility to protect the company from fraud. It's a responsibility of the management. But what is the auditor's responsibility? Auditor has to provide an assurance, that is a reasonable assurance, that the financial statements are true and fair. So write down the first paragraph. Maple and Company. Maple and Company are responsible for obtaining reasonable assurance that the financial statements taken as a whole are free from material misstatements whether caused by fraud or error, and this is the main responsibility of the auditor. Okay, this is the first thing. So whenever you get free time, like say every day in the evening, you practice a question on this site. Okay, this is given by ACCA to us, and make use of it. So in order to fulfill this responsibility, Maple and Company is required to identify and assess the risk of material misstatement of financial statements due to fraud, because that's the main responsibility of the auditor, to make sure that, to first of all provide a reasonable assurance and make sure that the financial statements are free from material misstatement which is caused by fraud or error. The prevention and detection of fraud is not the responsibility of the auditor, it is the responsibility of the management. But here in the first case, they've asked us the responsibility of Maple and Company, and Maple and Company is who's Maple and Company? They are our auditors. Okay. So next, to do this, what else they need? They need to obtain sufficient and appropriate evidence regarding the assessed risk of material misstatement due to fraud, and how they will do this? Through designing and implementing appropriate responses. Okay, then next, the auditor also has to maintain professional skepticism, that is, be alert to conditions which may indicate fraud or error. Whenever an auditor enters into a company, he should always have that mindset of a professional skepticism, that is, having a questioning mind. He should not listen to anything that the management says. Yes, up to a limit is okay, but then you need to question the management claims. You cannot just go in hand with the management, because you are entering as an independent person. Okay, so the next we have is, when obtaining reasonable assurance, I'm just writing down the responsibility that the auditor has to fulfill, and these are very simple. Okay, so when obtaining reasonable assurance, Maple and Company is responsible for maintaining professional skepticism throughout the audit. That is, being alert to conditions which may indicate possible misstatements due to fraud and error. Okay. Then next, If fraud is detected, if it's not the responsibility of the auditor to stop the fraud, but during the process of auditing a company, if he comes across a fraud, then what he will do? He cannot ignore the fraud saying that, oh, it's not my responsibility, so let me ignore it. Then what the auditor will do? So if fraud is detected, the auditor must report this to the management and those charged with governance. Okay, so this is the answer. You can spread it a little more and write this is for 4 marks. Okay, now next, the big fish. 6 audit risks and auditors' responses. Okay, so now how I'll write this is, I cannot make a table here. In the exam, ideally you have the table given. Listen carefully now. In the exam, ideally you have a table given. So what I'll do, I'll put a dash, that is the first one, then next dash, second one. I'll write the risk, I'll write 2 dots, and then I'll write the response. Okay. So for that you have to read the question. Yes. So let's start. It is 1 July 20x5. You are the audit supervisor of Maple & Company and are currently planning the audit of the existing client, Sycamore Company, for the year ended 31 May 20x5. Sycamore Company is a pharmaceutical company which manufactures and supplies a wide range of medical supplies. The draft financial statement show revenue of 35.6 million and profit before tax of 5.9 million. Now the question starts from here. Sycamore Company's previous finance director left the company in January 20x5 after it was discovered that he has been claiming fraudulent expenses from the company for a significant period. Now the finance director has committed a fraud. Sycamore Company's previous finance director left the company in January after it was discovered that he had been committing fraud. Okay, with regards to expenses claimed. There is a risk that he might have undertaken many more frauds which are yet not covered. Yes, this is an audit risk. The auditor might find this risk. Till now, you only know that he has been claiming fraudulent expenses because you have only found out about that much. But have you gone in depth? So the auditor has to go in depth. So that is the audit risk that the auditor will face. You only know that he has been claiming expenses which are fraudulent. But maybe there is something more to it. If you dive in deep, maybe there is something more. He might have undertaken many other fraudulent transactions, yes, which are not yet uncovered, and they should be written off in the financial statements. And if they are not written off, the financial statements could include a lot of errors because till now we only know that he has been claiming fraudulent expenses, but there might be many more things that he has been doing wrong which are not yet uncovered. So the auditor will uncover that. Okay, and when the auditor uncovers that, if the auditor doesn't uncover that, the financial statements will consist of errors. So what is an audit risk? In terms of errors, right? Audit risk means what? The errors that the auditor will face. So the first one, Sycamore Company's previous finance director left in Jan after it was discovered that he had been claiming fraudulent expenses, right? There is a risk that he may have undertaken other fraudulent transactions which we are not aware of, and they need to be written down or written off, and need to be written off in the statement of P&L. If these have not been uncovered, the financial statements could include errors. So what can be your response for the same? Response I'm writing here, okay? Now, till that time, the new finance director is already there on board. Yes, the new finance director has already come. So you discuss this issue with the new finance director, that what procedures need to be undertaken to find out more about the fraud that is conducted by the previous director, right? So discuss with the new finance director what procedures have been adopted to identify any further frauds by the previous finance director. In addition, the team should maintain their professional skepticism and be alert to the risk of further fraud and errors. The team should do their work and always be alert कि something else will be uncovered, something deep will be uncovered. We are ready. We are in a professional skepticism. We are ready to question the management. We are ready to dive deep further. Okay. Then the second one. The new finance director is now appointed, who was previously the finance controller of the bank. Now, bank is a very different institution from the pharmaceutical company. So it is very much possible that the new director appointed might not have the skills necessary to conduct the audit, because a pharmaceutical company is very different from a bank. So that is the next audit risk, that he might not be able or she might not be able to conduct things properly in the company because she was previously a financial controller of the bank, and bank is very different from a pharmaceutical company. So the new finance director was appointed in Feb and was previously financial controller of a bank. Sycamore company is a pharmaceutical company which is very different from a bank, right? Bank is very different from pharma. So what is the audit risk? But first you write down the problem, but then you write down the audit risk. So there is a risk that the new finance director is not sufficiently competent to prepare the financial statement. This is the audit risk. After the problem, you always have to write what the risk is. In the point above also, see, you have written in the second line, there is a risk that he might have undertaken many other fraudulent transactions which we are not aware of. So similarly here, there's a risk that the new finance director is not sufficiently competent to prepare the financial statements. And because of this, the financial statements could contain errors. Okay. Then what can be your reply to this? As an auditor, what can you be? What can you do during the audit? You can just be careful, because you know that the financial controller doesn't have that much experience. He might make mistakes, so you should be ready to take that mistakes. So you should be careful during the audit and see if everything is proper, everything is applied appropriately. So the response is, during the audit, careful attention should be applied to any changes in accounting policies and in particular any judgments. You need to pay proper attention to any policies and any judgments undertaken by the financial controller, because those policies and those judgments might be wrong. Because don't forget, he or she was previously a financial controller of the bank, and bank is very different from pharma. So you need to pay careful attention to any changes in accounting policies and in particular any key judgments, decisions made by the finance director. Okay. Second one is done. Now third. We have to write 6, right? Now third one is here only. I told you when I read the question only. 1.8 million is used on developing several new products. These products have not even reached the final stage. Still the entire amount is capitalized, which is absolutely wrong. According to IAS 38 intangible assets, only products that reach the final development stage should be capitalized. The remaining amount should be expensed out. So there is a risk that some projects may not even reach the final stage, and hence should be expensed rather than capitalized. And if this is not done, intangible assets and profits will be overstated because you've already capitalized it in intangible assets. So if the products don't reach the development stage, the intangibles will be overstated. So write down the third one. During the year, Sycamore has spent $1.8 million on developing new products. These are at different stages and the total amount has been capitalized as an intangible asset. Now talk about the risk. What is the risk? In order to be capitalized, it must meet all the requirements under IAS 38 intangible assets. Okay. Now talk about the risk. There is a risk. In every point you have to talk about the risk. The examiner will not see and check and assume that, oh, this might be the risk. You have to tell him that this is the risk. So there is a risk that some projects may not reach the final development stage and hence should be expensed rather than capitalized. And if you don't do that, intangible assets and profit could be overstated. Okay, so what can be your response towards the same? A breakdown of development expenditure should be reviewed and tested in detail to ensure that only the projects that meet capitalization criteria are included, right? Only those who reach the stage are included, the rest are expensed, are included as an intangible asset with the balance being expensed. Now next, there's a bank loan. Whenever there's a bank loan in your sum, close your eyes and write down what I'm writing just now. Anytime in any question, you're given to find out the audit risk and give auditors responses. And in the question, if there's a bank loan, close your eyes and write down this point. So in order to fund this development, 2 million was borrowed from the bank and is due for repayment over a 10-year period. The bank has attached minimum profit targets as a part of the loan covenant. So whenever there is a bank loan, just close your eyes and write down the point. There are 2 points in bank loan. I'm giving you the first point now. Now listen carefully. There's a bank loan of 2 million which is due for repayment over a 10-year period. So this 2 million you have to repay over a period of 10 years. When you have to repay over a period of 10 years, whatever amount that you have to repay within 1 year will be your current liability, and whatever is beyond 1 year will be your non-current liability. So out of the 2 million, whatever the first installment that you're paying within 12 months will come in current, and the remaining 9 years ka amount will come in non-current for this particular year, the year in which you're taking the loan. So there is always an audit risk that the split off between current and non-current liabilities is incorrect. So this one point will always come in loan. Whenever you have a loan, always remember loan, okay, the split between current and non-current is not proper. So just close your eyes and write this point down. Sycamore company has borrowed $2.0 million from the bank via a 10-year loan. There is always an audit risk there is a risk that the loan is not split between current and non-current liabilities correctly, resulting in incorrect disclosure. Okay, so this one point is there. This is one point, that the split between current and non-current is not proper. In addition, with every loan, you have to pay an interest. I hope you're aware of the same. Today, if I'm taking the loan, the first installment is after 1 year. So I have to pay an interest of 1 year on that. The next installment is next year. So on the next installment, on the remaining amount, I have to pay an interest for the remaining years. Like that, I have to go and pay the interest. In addition, there is one more risk in this, that the interest is not being included in the books of accounts. The management has forgotten to include interest amount, that is the finance cost. So that is one more audit risk. In addition, the loan should result in additional finance cost, right? Because we have to pay interest on the loan. So additional finance cost. There is a risk that this has been omitted from the statement of P&L. That is, the management has forgotten to include loan, leading to understated finance cost and overstated profit, right? What will be the response of the audit team on the same? First of all, what the auditor will do is, auditor ka procedures are systematic. First, the auditor will confirm that actually did the company really take a 2 million loan. So confirm if the 2 million loan has actually been received. Then if the loan is correctly split between current and non-current, so whatever is payable within 1 year is current and whatever is payable beyond that 1 year is non-current. And third, the auditor will calculate the finance cost, that is the interest on the loan, and make sure the interest is properly recorded. So start. During the audit, the team would need to confirm that $2.0 million loan finance was received. In addition, after once it is confirmed that it is received, then you will next concentrate on the split between the current and non-current. So in addition, the answer just got deleted. I will start from where I stopped, okay? Okay, so there's a loan. First thing you will do is the team would need to confirm that actually 2.0 million loan has been actually received. After that, second thing the auditor will do is confirm that the split between the current and the non-current is proper. Yes. And third, finance cost, the auditor will recalculate and see if the finance cost has been properly included. Okay. Now that was the fourth point that we had. Okay. We need 2 more. We'll write the 2 more points here. Sorry guys, it just by mistakenly got deleted. Then next, the new finance director has informed the audit partner that since the year ended, there has been an increased number of sales returned, and that in the month of June, over 0.5 million of goods sold in May were returned. So, increase in the number of sales returned. Now, for example, sales are happened in the last month. For example, sales are happened in January and the returns came in March. But the returns cannot be recorded and cannot be subtracted from the March sales. The returns are pertaining to the Jan sales, so it has to be reduced from the Jan sales. Okay, because returns will not come the day after sale. The returns will come after some time. So if the sale is made in January, the returns are received in March. Yes, it should be reduced from Jan sales. It should not be reduced from March sales because these returns pertain to sales made in January. So there is an audit risk that this is not done. There is an audit risk that the sales return have not been correctly subtracted from the respective sales. So that is the next point. So you will write down. There have been. Now before this point you can also write a heading. For example, for every point you can write a heading. Sales return. And then you can write. There have been a significant number of sales returns made subsequent to the year end. Okay, as these relate to pre-year end sales, as this is regarding the pre-year end sales, so it has to be subtracted from that sales. You cannot subtract it from the remaining sales. Sometimes what happened is, see, my year end is December, I made sales during the year and I got returns next year, so I cannot reduce the returns from the next year's sales. I have to reduce it from that year only. Yes, so as these relate to the pre-year end sales, they should be removed from revenue in the draft statements, and the inventory should be restated. Okay, if sales return is not correctly removed from, if sales returns is not correctly subtracted, is not correctly recorded, then revenue will be overstated and inventory understated, right? Because revenue, if this is my year end, okay, till year the sales are done and this year I receive the returns, but these returns are pertaining the previous year. So if I don't subtract it from the previous year, the revenue and the inventory both will be understated, right? Revenue will be overstated and inventory will be understated, because the revenue is also top, I have to reduce it, and the inventory is understated, I have to add it back because I have got things in return, so I have to add it to the inventory. If I don't add it to the inventory will remain understated and revenue will be overstated. So what can be your response for the same? What response you will give? Review a sample of post year end sales returns, that is after the year end, whatever sales returns you have got, pick a sample from that. Maybe 10 goods you have got as return. Out of the 10 goods, pick up a sample and see if the sample is being correctly recorded. Check where the sample has been recorded. Ideally, the sample should have gone to the previous year and subtracted from the sale. So see if it has been appropriately recorded in the previous year's sale. So that will be your response. So what will be your response? Review a sample of post year end sales return and confirm if they relate to pre-year end sales that the revenue has been reversed, because you have to, those who return the goods to you, you have to return back their money, so the revenue also has to be reversed, and the inventory included in the year end ledgers. Okay. Then one more thing, sales returns have come so much. How much is it? 2.0 million. How much? 0.5 million of goods were returned. This is a huge amount. So find out the reason. As an auditor, you can find out the reason why so many people are returning the goods. Is there some fault in the goods? Yes. So in addition, Whatever I've written after the dot is the auditor's response, okay? So don't get confused. This is auditor's response. At the start of the question, I told you, since here I am not able to draw a table. In the real exam, the table will already be given to you. So anything after the two dots is the response. This is a risk and response. In the table you have to write. So in addition, the reason for the increased level of returns should be discussed with management. Like, discuss with management why so many people are returning the goods, right? And then Maple and Company attended the year-end inventory count at Sycamore Company's warehouse. The auditor raised concern that during the count there were moments of goods in and out of the warehouse and this process did not seem well controlled. Now imagine I'm counting number of students in the class, okay? I'm the teacher. I teach at a live class and there are so many students in the class which I'm not aware of, and I'm counting the students. And while I'm counting the students, there are a few students who are going out, coming back, going out, coming back, and everybody wears the same uniform. So the teacher is confused if she's counting a particular student twice, or maybe she's completely not counting a student. Because during the count process, if there is a constant movement of people, how will she count properly? Yes, while she's counting, the amount should be like the students should be stagnant. She should close the doors and then count. Only then she will get the right number. If there's a constant movement of goods going out, going in, constantly students are going out, students are coming in, maybe she will count a student twice, or maybe she will not count a student at all. So here the same situation is happening. While the year-end count is going on, there are constant moments of goods in and out. So you are now confused which goods you counted twice and which goods you didn't count at all. Yes, so that is the next audit risk, that is inventory count moments. And because of this, the audit risk is that the inventory would be counted more or would not be counted at all. So this is the next point. So the heading will be inventory count moments. I think it's better to give the heading so that the examiner will know, okay, this is what you're talking about. So inventory count moments. Okay, so during Sycamore Company's year-end inventory count, there were moments of goods in and out. If these goods in transit were not carefully controlled, then goods could have been omitted or counted twice. Okay, and this would result in inventory either being understated or overstated. Under or overstated. So what will be the auditor's response for the same? During the final audit, the goods receipt notes, GRNs, and goods dispatch notes, GDN, should be reviewed and followed through. That they should be checked and the follow-up should be then and should be followed through into the inventory count records as correctly included or not. Okay, then the next one. During the year, a review of plant and equipment in the factory was undertaken. There was a surplus plant sold, resulting in profit on disposal of 2,10,000. Now, when we read the question only, I told you this is a massive profit. And whenever there's too much profit or too much loss, it's like an indication that the depreciation policy is not proper. So, the next heading is profit on disposal of PPE, that is property, plant and equipment. So, profit on disposal of PPE. Okay. Surplus equipment, surplus plant and equipment was sold during the year, resulting in a profit of disposal, profit on disposal of $210, right? Now pay attention. Significant profits or losses on disposal. 2,10,000 is a huge amount, right? So significant profits or losses on disposal are an indication that the depreciation policy of plant and equipment may not be appropriate. Depreciation may be overstated as a result. So what will be your response? Auditor's response. Discuss what the auditor will do now. The auditor has found out that the profit on disposal is 2,10,000, which is a huge amount, and the auditor said that this would be because of that the depreciation policy is not proper. Yes, so the auditor will discuss with the management that what is the depreciation policy that they are using. So discuss the depreciation policy for plant and equipment with the finance director to assess its reasonableness. Like, find out that on what basis they have, calculated the depreciation. So that is for 12 marks. We found out, I think, 7 risks and 7 responses. You can do 6, no problem. Then the next part, the C part. Explain the purpose of review engagements and how these differ from external audits. What is the meaning of review engagement and how is it different from external audit? Now, to my students who are attending this revision, we've already done in class the difference between review engagement and external audits. You just have to write it down for 2 marks. Before that, read whatever is given above. Sycamore Company's new finance director has read about review engagements and is interested in the possibility of Maple and Company undertaking this in the future. However, she is unsure how these engagements differ from an external audit. So she wants to know how is the review engagement different from external audit. So let's tell her and let's explain to her what is a review engagement. Okay, so explain the purpose of review engagement and how this differ from external audit. And describe the level of assurance provided by the external audits and review engagements. So let's show the new finance director. So see part A. So we are doing CA. Okay. So what is review engagement? Okay. So this is a complete independent question. For this you do not have to read the question. This type of requirements are you should know by heart, which you have already studied from the book. This has got nothing to do with the question. So write down the definition of review engagement, whatever you have studied so far. So review engagements are often undertaken as an alternative to an audit and involve a practitioner reviewing financial data such as 6 monthly figures. This would involve the practitioner undertaking procedures to state whether anything has come to their attention which causes the practitioner to believe that the financial data is not in accordance with the financial reporting framework. Okay. And how is it different from external audit? So write that in paragraph number 2. 2 marks, right? So how is it different from external audit? A review engagement differs from external audit because the procedures undertaken are not as comprehensive. What is comprehensive? Detailed. They are not as comprehensive as those in an audit. In addition, in review engagements, the practitioner does not need to comply with the standards, whereas in audit you have to comply with the standards. The auditor does not need to comply with international standards on auditing. Okay, and then the B part. Describe the level of assurance provided by the external audits and review engagements. So obviously, external audit will provide a high level of assurance. Review engagements will provide a low level of assurance. Yes. So write down. Again, here you can make a table, 2 columns, level of assurance. In one column you can write external audit, and one column you can write review engagement. So level of assurance in external audit or high, but not absolute assurance, because nobody can give absolute assurance, is provided. This is known as reasonable assurance. And in review engagements, negative assurance, negatively worded assurance. Okay, so now the moment I confirm, now this time is wrong because the part of our answer got deleted, so there we took us some time. So now don't look at this time, by mistakenly it got deleted where I swiped the screen. So the moment you press confirm, you will get your answer and the standard answer. So this is the standard answer. You can compare it with your answer. Now standard answer is going to be according to the exam standard, like according to the main this thing. You need not write so much in detail. If you write so much in detail, then somewhere your time will get wasted. So you can write close to that, but not exactly like this, because this is too detailed, because this is the, what you can say, the specimen answer. It has to be perfect, but we are not that, yes, if you can write that much, it's well and good, but you have to then complete within that time frame. Okay, I'm not telling you write a very generalized answer, but this is a standard answer. You need to understand. Now this part A, fraud responsibility, is for 4 marks. So this they have written in a paragraph form. You can split and write in points. You can give a good presentation to that. Yes, and by hearting is not the rule, because every question that you get in the examination is different from the previous question. So ऐसा नहीं है कि this same question is going to come. That is why by hearting is out of question. But here what I did is, whatever knowledge I had gained so many days while studying from the text and all of that, I just applied that knowledge. So if this is the audit risk, this is what I'll do. If this is the audit risk, this is what I'll do. So I just applied my knowledge. I didn't by heart anything. I didn't put anything. But having said that, the last part, like this one, the review engagement and all, these is the by hearted part, because this was an independent question. This was not dependent on the question. I didn't even read the question to answer that. The difference between review engagement and external audit is something that you need to know. Okay, and this finding out audit risks and auditors' responses was application. So I hope you guys were clear with this particular question. You can expect questions like these in the examination, wherein you don't have to by heart anything. You have to apply your knowledge, unless the requirement is independent, wherein then you have to write whatever you have studied, like the difference between external audits and review engagement. Okay, now this was only for 2 marks, but see, so much they have written, because this is an exam standard answer. This is a benchmark that they have said, and you have to reach as much as closer to the benchmark as possible, but within the given time frame. Okay, so this is the question and the answer which we have done. Now I'll take a break of 5 minutes before we start something new. Okay. Okay, now let's do the next question. Let's do this one. This is a 30 marker, but we're just going to do the part B since we have freshly studied audit risks and auditors' responses. So I want you to take time, read the audit risks and auditors' responses, and see how many you can identify. While I've opened this here, you open it in your ACCA study hub. Till then, I'll quickly check the comments. See how many you can identify, and then we're going to solve it together. Okay, don't worry about that. See, so while I've opened this study hub here, you also open your study hub and try to identify risks and responses because it's freshly studied by us. Okay. Okay. So whenever we do a question, we have to do the requirement first and then do the question. Out of this requirement, we are only doing the requirement part B. So only read that much. Describe 8 audit risks and explain the auditor's responses to each risk in planning the audit of Heart Company. 8.16. Now read the question. Heart Company. It is 1 July 20x5. You are an audit supervisor with Morph and Company responsible for planning the final audit of a new client, Heart Company, for the year ending 30th September 20x5. Whenever in the requirements you have to find the audit risks, and in the question you have that the company is a new client, just close your eyes and write down new client. Having a new client is always an audit risk. Having a new client is an audit risk because the company is not well versed with the procedures of the client because the client is new. And so it is an audit risk because the procedures, policies of the client you're not well versed with. So you already got your first point. Okay. Hart Company specializes in the design and construction of customized playgrounds. The audit manager recently met with Hart Company's finance director and has provided you with the following notes. The first one is planning meeting notes. Hart Company has a forecast profit before tax of $12.2 million and total assets are expected to be $28.5 million. The finance director has indicated that the directors are very pleased with the forecast performance for the year as the directors paid a bonus based on percentage of profit before tax. Hart Company is undertaking the construction of playgrounds at 16 sites in various locations across the country. All playgrounds are constructed to specific customer specifications. Customers pay a 25% deposit on signing the contract with the balance payable when the control of the playground is transferred to the customer. The balance of work in progress at 30th June 2025 is 7.6 million in respect of the playgrounds under construction. A work in progress count and valuation will be carried out at AU sites on 30th September 2025. Arrangements have been made for the audit team to attend only 5 of the work in progress counts. Hart Company offers to its customers a warranty at no extra cost with guarantees that the playgrounds will function as expected for the period of 3 years. The warranty provision for the current year has been calculated as 2% of revenue. In the previous year, the warranty was based on 6% of revenue. The finance director has made this change despite no significant difference in construction techniques or the level of claims in the year. Hart Company has incurred expenditure of $1.8 million relating to the research and development of a new type of environmentally friendly building material. $0.6 million of the expenditure to date has been written off to the statement of P&L. The remaining $1.2 million has been capitalized as an intangible asset. No amortization has been recognized to date as the material has not yet been brought to use. In June 2025, the company contracted to purchase new machinery costing $2.4 million. It paid $1 million on signing the contract to secure the machinery, which was due to be delivered in July 2025. Due to a supplier problem, the delivery is delayed and is now scheduled to be delivered in October 2025. In order to finance the research and development cost and the machinery purchase, Hart Company made a rights issue to existing shareholders at a price of $0.75 for each $0.50 share. So, rights issue of 0.75 for every 0.5 that you own. Okay. Hart Company's payroll function is outsourced to an external service organization, CHAS Company, which is responsible for all elements of payroll processing and maintenance of payroll records. Hart Company's directors correctly disclosed their remuneration details in the forecast financial statements in line with IFRS standards. However, local legislation in the country in which Hart Company is based requires more extensive disclosures. The directors have stated that they consider this onerous and so do not intend to provide the additional information. Okay. 8 audit risks and auditors' responses, out of which we have already got 1 audit risk. Yes, so the first audit risk is it's a new client. Okay, so put the heading new audit client. Okay, so the first one we have is new audit client. So what is the risk? Hard company. See the way I'm writing the answer. Okay, hard company is a new client hard company is a new client for Morph and Company. As the audit team is not familiar with the accounting policies transactions and balances of hard company, there will be an increased detection risk on the audit because you're not well versed with the client. This is the first time that you're auditing the client, so you don't know the client well, you're not well versed with the client, so your detection risk will increase because first you need to have a complete idea of how the client conducts its transactions, what are the policies of the client, and once you get all the details about the client, then you can work properly. But this is the first time that you're auditing, so you're not that well versed with the client. So there is also less assurance on opening balance. Why? Because current year opening is last year closing, and last year closing is taken and directly brought to current year opening. But last year you were not the auditor was somebody else, so we do not have any assurance about that figure because last year I did not conduct the audit. So there is also less assurance on the opening balance as Morph and Company did not perform audit last year. So what will be your response for the same? What response can you give? This is the first time that you're auditing a new client. Yes, this is the first time. What will you do? Because you're not well versed with the policies, you're not well versed with the transactions. So since it's the first year and you have to be a little careful, you ensure that you take a suitably experienced team with you. Okay, so what you will do? Morph and Company should ensure it has a suitably experienced team assigned to the audit and that adequate time is allowed for team members to obtain an understanding understanding of the entity. Once you obtain an understanding of the entity and you're well versed with the entity, then you can conduct the audit properly. But unless and until you have a proper idea of what the company does, what are the policies and procedures of the company, how is the thing done, you cannot really do anything about it. So that is the first one. Also, one more thing we have said about the opening balance, because the opening balance has been bought from last year closing and we were not the auditor of the last year. So we don't have that much confidence on the opening balance because it was conducted by somebody else. So then, increased audit procedures should be performed over opening balances. Okay, so this is the first point. Next, Hart Company has a forecast profit before tax of 12.2. Last year it was 9.8. Total assets of 28.5. Last year it was 24.3. The finance director has indicated that directors are very pleased with the forecast performance for the year, as the directors are paid bonus based on the percentage of profit before tax. Now this is a very big risk. If the directors are paid based on the percentage of profit before tax, directors would try their best to overstate the profit, because it's a human mentality. Everybody wants to be paid maximum. So if my bonus is based on profit before tax, I would want the profit before tax to be maximum. So there is an audit risk that the profit before tax figure is overstated by the directors because they want their bonus to be maximum. So that is the second audit risk. So are you guys getting how to identify the audit risk? Yes? So the second one we have is director's bonus. Okay, the directors are paid bonus based on percentage of profit before tax for the year. And due to this, there is a risk. What is the audit risk? For every point you have to write what is the audit risk. If you guys remember, I told you in the last question also. So there is a risk that the directors will try to overstate profit, and therefore their bonuses by increasing the revenue and income recorded and decreasing expenses. So what can be the response for the same? Now you know that the bonus is based on profit before tax and the directors will try their best to overstate, right? So you as an auditor, what will you do? What will be your response? The response is what auditor will do. We have identified what risk can be there. See, audit risk is not given in the question. You have to use your brain and think this is a situation. Because of this situation, what can the audit risk be? Okay, so we identify that directors will try their best to overstate and all of that. Now, based on this, what will be auditor's response? What the auditor can do? The audit team knows that the directors are going to try their best to overstate the profit. So you be aware of the same. You maintain professional skepticism on profit before tax, right? So what? The audit team should be aware of the increased risk of manipulation and should assign more experienced audit members to significant estimates and judgmental areas. Also, you need to give adequate time to the team members to understand the situation and pay special attention. So that is one more point that you can add. Now the third one, come to the question. Hart Company is undertaking the construction of playgrounds at 16 sites in various locations across the country. All playgrounds are constructed to specific customer specifications. Yes, they are taking currently construction of 16 playgrounds, and every playground has some specified, specification. They're designed according to the specifications. Okay. Customers pay a 25% deposit on signing the contract, with the balance payable when the control of the playground is transferred. So first, when the order is given, 25% money is paid. The remaining is paid when the playground is ready and the playground is, given to the customer. So then revenue of 25% should be recognized before and remaining after. So the deposit should not be recognized as a revenue immediately, because this is a deposit which is an advance given, and instead should be recognized as deferred income within current liabilities until the performance obligation is completed. Because according to IS 5 revenue recognition, revenue should be recognized as and when the performance obligation is satisfied. Advance is given but the work is not yet started. Advance you cannot recognize. So according to revenue recognition, revenue should be recognized as and when the work is done. So when 25% work is done, that time you can recognize your 25% revenue. So then what is the risk in this? There is an audit risk that revenue is overstated and the current liabilities are understated if the deposits have already been recognized into revenue. So if the deposits have already been recognized in revenue, the revenue will be overstated. It should be recognized in terms with the work done. So that is the third point, which is revenue recognition. By now you might have understood how to identify audit risk. First identify the problem, then say what you feel the risk can be, and then give the response on the same. Okay, so start with this. Customers pay 25% deposit on signing the contract to purchase the playground. The deposit should not be recognized as revenue immediately, and instead should be recognized as deferred income within current liabilities until the performance obligation have been satisfied. Okay. There is a risk. Now say about the risk. For every point I told you, you have to write what is the risk. The examiner will not search that, oh, she means that this is the risk. You have to write it in clear terms. So there is a risk that revenue is overstated and current liability is understated if the deferred liability is not recognized. Understated if the deposits have been recorded within revenue. So now what can the auditor's response for the same be? What can the auditor suggest? The auditor should first of all understand the different performance obligations in the contract, and then revenue should be recognized as and when the performance obligation is satisfied. But for that, the auditor has to first understand the contract and what are the different performance obligations in the contract. So the audit team should obtain a copy of the contracts with customers and review them to understand the performance obligations. And accordingly, revenue should be recognized as and when the performance obligation is satisfied. Next we have is the fourth one. The balance of work in progress at 30th June 20x5 is 7.6 in respect of playgrounds under construction. So there is a lot of work in progress because at once they have started 16 sites. So not all are complete. And unless and until they are complete, they will be work in progress, right? So there has to be a work in progress count. So a work in progress count and valuation will be carried out at all sites. It's not all. AU sites, 5 sites. See, in the next line it's given. And arrangements have been made for the audit team to attend only 5 of the work in progress counts. So 5 is not even like half of 16. Total work in progress, you have 16 sites. Out of that, you're attending only 5. So imagine, as the audit team is not attending all the sites, detection risk is increased. You're not even attending half. Ideally, you should at least attend 75% of the sites. But here you're just attending 5 sites out of the 16. So the audit risk is that since you're not attending all the sites and only attending 5 sites, the detection risk increases. Okay, so next we have is work in progress. So what is the audit risk? The audit team will only attend the WIP counts at 5 of the 16 sites, right? So work in progress is a material balance and the valuation of work in progress is a judgmental area. Right? As the audit team is not attending all sites, detection risk is increased as the team will be unable to directly obtain evidence relating to work in progress. So what can the auditor do on this? What can the auditor's response be? At least more than 5 need to be attended. At least 50% the auditor needs to do, and wherein the auditor should select the sites based on if a site has a very big balance, very material balance, and that sites should be done first. So the auditor should assess which inventory counts the team will attend. Most likely to be those with the most material work in progress or those having greater risk of misstatement. Okay, this will be attended. And for those places which the auditor will not be able to attend, the audit team will need to obtain a review documentation relating the control. So the auditor will send somebody else, but whatever that somebody else finds out from those sites need to be properly reviewed by the auditor. So for those inventory counts, not attended, the audit team will need to obtain review documentation relating to controls surrounding the counts. Okay, then the next one, from here. Okay, Hart Company offers its customer a warranty at no extra cost and provides guarantees that the playground will function as expected for a period of 3 years. So there's a guarantee and a warranty provision. And the warranty provision for the current year has been calculated as 2% of revenue. In the previous year, it was 6%. Okay. Now, warranty provision is under IS 37 provision, contingent liabilities and contingent assets. The provision is calculated at 2% of revenue for the current year, and for the previous year there was 6%. How can you change the provision from 6% to 2%? No other change has occurred. The finance director has made this change despite no significant difference in construction technique or level of claims. Level of claims is the same, construction technique is the same, then how did you reduce the provision from 6% to 2%? So that is the audit risk under IS 37, provisions, contingent liabilities and contingent assets. This should be recognized as warranty provision. Calculating the warranty provision requires judgment. And there's a risk that warranty provision is understated for this year because everything remains the same, the claim remains the same, the technique remains the same. But this year, the management has reduced the provision from 6% to 2%, which is absolutely wrong. Okay, so there's a risk that warranty provision is understated. So write down the next one. Next one is regarding warranty provision. So I will just write it in short, okay? Current year is 2%. Last year was 6%. And despite everything remaining the same, okay? So what is the audit risk? I'll directly start from audit risk. First of all, under IS 37, provision, contingent liabilities and contingent assets, calculating warranty provision requires judgment. As it is an uncertain amount, because we don't know how many people will want warranty, because it's an uncertain amount, so it requires judgment and experience. But what is the risk? There is a risk that the warranty provision could be understated, leading to understated expenses and liabilities. And what can be the auditor's response for the same? The audit team should also compare the prior year provision with the actual level of claim in the year to assess the reasonableness of the judgments made by the management. Okay. The next, which is the sixth one, research and development expenditure. Hart Company has incurred expenditure of 1.8 million relating to the research and development of a new type of environmentally friendly building material. 0.6 of the expenditure has been written off to the statement of P&L. The remaining 1.2% at 2 million has been capitalized as an intangible asset. No amortization has been recognized to date as the materials has not yet been bought to use. Now, according to intangible asset, you can only capitalize if the product is reaching the development stage. There's a strict criteria to capitalize the development expenditure. And there is a risk that these requirements have not been applied, any amount has been capitalized randomly. Ideally, there are strict rules and regulations. Capitalization can only be done when the product reaches the development stage. So the next one is regarding research and development. I'm again writing it down in short because by now I assume that you guys have understood. So R&D. I'll directly start from, you write the situation. Like Heart has recognized 0.6 million in P&L and 1.2 has been capitalized. Now according to IAS 38 intangible assets, IA, that is intangible assets, has a strict criteria as to which the cost can be capitalized. As development expenditure. Okay. And what is the risk? There is a risk that the requirements of the standard have not been applied correctly. If research has been wrongly classified as development, there is a risk that intangible assets could be overstated and research could be understated. So that also point you right. If research has wrongly been classified as development and capitalized, development will be overstated and research will be understated. And what will be your response on the same? Audit team needs to first obtain a breakdown of research and development cost, wherein research will be expensed to P&L and development will be capitalized depending on the supporting documentation of the same. Okay. So I will just write breakdown. Research expensed to P&L and development. Development, what you will do? Capitalized after reviewing supporting documentation. Okay, but write it down properly. Then seventh one. In June 20x5, the company contracted to purchase new machinery costing 2.4. It paid 1 million on signing the contract to secure the machinery, which was due to be delivered in July 20x5. Due to a supplier problem, the delivery is delayed and now it is scheduled in October. In order to finance the research and development costs and the machinery purchase, Hart made a rights issue to existing shareholders. For each 0.5 share, Hart offered 0.75. Okay. Now you've already placed an order for 2.4 million of machinery, out of which 1 million is already paid for machinery. But only assets which physically exist at the year end can be capitalized. Now 1 million that you have already paid, but you have not received the machinery. It's to be received in October. So the machinery is due to be received in July, but it has not yet been received. And at the year end, only assets which physically exist need to be capitalized. So what you will do with 1 million? 1 million cannot be capitalized because the machinery does not physically exist at the year end. so it will be treated as a prepayment. Okay, that is an advance. So if the deposit of 1 million paid in advance has been capitalized, so there's an audit risk that this 1 million has been capitalized. So if the 1 million has been capitalized, then property, plant and equipment will be overstated. Okay, so that is the next audit risk regarding the PPE. Hard company placed an order for 2.4 million of machinery. $2.4 million you write down. Paying $1 million advance. The machinery was due to be received in July 20x5, but will now be delivered post year end. According to the standard, only assets which physically exist at the year end should be capitalized as PPE. The $1 million deposit paid in advance should be recognized as a prepayment. If the 1 million is capitalized, if the $1 million then PPE will be overstated, and prepayment will be understated, because prepayments are taken to PPE and they are capitalized. So prepayments will be understated. Okay, so what will be your response, auditor's response? Review the non-current assets register to determine if 1 million paid in advance has been capitalized or not. Discuss the correct accounting treatment with the management regarding what they have exactly done. So, review the non-current assets register to determine if the $1 million paid in advance has been capitalized. Discuss the correct accounting treatment with management to confirm that the amount paid in advance is recognized as a prepayment and not incorrectly recognized in asset. So that is the 7th one. And the last one, If they've asked 8, you might get 10, but you write the best. Okay, now if you see here, Heart Company's payroll function is outsourced to an external service organization. Whenever there's an outsourced function, close your eyes and write down this point. Detection risk arises because it's an outsourced function, so we cannot give guarantee for that outsourced function. So a detection risk arises as to whether sufficient and appropriate evidence is available, because we are not doing the work but we have outsourced it. We as in the company. So the auditor will always have this problem. Okay, that is one. Then Heart Company's directors correctly disclose their remuneration details in the forecast statement in line with IFRS standard. However, local legislation in the country in which Heart Company is based requires more extensive disclosure. The directors have stated that they consider this onerous and do not intend to provide additional information. Now, whenever local legislation requires a company to do something, the company has an obligation to do that. If the company has not done that, that means they have not complied with the IFRS standards of the local legislation. Always remember, whenever a local legislation requires a company to do certain things, you have to 100% do that. So let's write that point on director's remuneration. So there is an audit risk that the remuneration procedures are not complete, because if you have not complied with the local legislation, your procedures will not be considered as complete. So director's remuneration. Director's remuneration disclosures have been made in line with IFRS standards but not local legislation. Where local legislation is more comprehensive than IFRS standard, it is likely that the company must comply. Whenever you have a choice between IFRS and local, you should go with local. So likely that the company must comply with local legislation. Because the directors, this is a risk, okay, remuneration disclosure will not be complete if additional information is not disclosed. So what you will do, what will be the auditor's response for the same? Because this is a risk that I will just write it down. There is a risk that the director's remuneration disclosure will not be complete if the additional information is not disclosed. So what will be the response of the auditor on this? Discuss the matter with management and review the requirements of local legislation to determine if the disclosure in the financial statement is included appropriately. Okay, so this can be your auditor's response for this. So your 8 points are done. Just go through the point and see if you have any doubt. Till then, I will quickly check the comments. Okay. So let me see if there are any comments, if there are any doubts on the same. The reasonableness of the judgments. That is one. Then, hard companies directors correctly disclose their reputation details on the forecast statement in line with IFRS. Guys, if any doubts, please put in the chat box. Forecast statement in line with IFRS standard. However, local legislation in the country in which hard companies based requires more extensive disclosure. The directors have stated that they consider this onerous and do not intend to provide additional information. Now, whenever local legislation requires So today we completed audit risks and auditors' responses. Tomorrow we'll do deficiencies, controls, test of controls, or control strengths and test of controls, or deficiencies and recommendations. Okay. So when you confirm this, you get the right answer. So this is your answer, and this is the answer of them, ACCA standard. Okay, so you can compare that and you can see. So if you want to compare there, you can also compare and see. So tomorrow we'll do deficiencies. We'll do deficiencies. Then on 10th November, that is Friday, we'll do substantive procedures. And on 11th November, we'll see how much mock we can do. Okay, depending on your response on the same, we will be solving a mock. So this is the standard answer. See director's remuneration that we did just now. The director's remuneration disclosure will not be complete if additional information is not disclosed. And then this is your response that the auditor will give. Okay. So that's it with today's live, guys. Thank you so much for attending the live. It was great having you guys. Thank you so much for attending the live. And please make sure you attend tomorrow's live also, because tomorrow we're going to do questions on deficiencies, controls, and test of controls. Okay. So make sure you attend that tomorrow. Very, very important questions. These questions 100% are asked in your AA. If you want to clear AA with good marks, this revision is like a cherry on the cake for you. So please make sure that you attend this revision. Very, very important questions, and we're doing it on the study hub. So nothing can be greater than that. And mock, I'm planning to do it on the constructive workspace, which looks exactly like the exam. So like half and half pages divided, and there you write the answer and all of that. Okay, so please make sure you watch through the recordings. Okay, thank you so much, guys. Thanks for attending.